For the record, welcome everybody to another installment of Amory's this is Accelerate Montana's Rural Innovation Initiative and our Open Office Hours series, which is intended to provide entrepreneurs of rural Montana timely answers to questions they have, whatever they might be. We've been really focusing earlier this spring on the PPP and other federal programs for folks being impacted by COVID. And now we've switched in the last couple of weeks, we're really focusing on financing and funding. Our overall goal at Amory is to support rural entrepreneurs in whatever way we can do that. And we have some folks on here that can also support entrepreneurs. And Brian, I think you're the only entrepreneur on the call here. You're probably new to this environment. So just to let you know, this is very much conversational style. Andrew's going to present for a little bit, and then we'll have question and answers. And I've got a few answers or questions that came in, and maybe a few answers from some folks via email that we'll bring up as well. So with that, Andrew and I have been talking for months now, I think, about vaguely this topic, and he's been working hard, and I think he has now pulled together a very interesting offering for Montana and entrepreneurs in Montana. And he's here to share what it looks like Crowdfunding Main Street is all about, and where there's some real opportunities right now. So thank you, Andrew, for taking the time and joining us and sharing your work and expertise. If you want me to, let's see, make sure you're.
Looks like it's allowing me to share. So if you're ready for me to go, I can.
Yeah, go for it.
Okay. So yeah, like Carl said, I'm going to talk for just like 10 minutes or so to give you a little bit of background of how this came together and hopefully give you some good context. If you have questions at any point, don't hesitate to jump in. I'm going to just kind of rip through this. So feel free to just yell stop and ask me what you need to. And you can also throw something in the chat if you want to do that as well. So my name is Andrew Connor, and I'm the founder and director of the Center for Community Ownership, which is based here in Missoula, and we work nationwide. And I'm going to tell you a little bit about that as the background before we get to kind of the main course, which is talking about this Crowdfund Main Street project. Like I said, we work nationally. We do projects around community ownership all over the place. And what that means is we are working to sort of help communities create wealth and economic well-being, really trying to empower them with this particular strategy of community-owned businesses to allow them to fill holes in their local economy, to drive community development, basically any need that they have that's not being served by chain stores, traditional entrepreneurs, traditional investors. We can bring this method of creating community-owned businesses to the table to sort of help do that. So we do that in kind of two ways. One is creating new community-owned businesses. So if there's a place that is lacking a grocery store or a retail store or a meat packing facility or a pharmacy or a childcare facility or whatever it may be that is not happening, the sort of normal channels are not producing that business, the community can come together, organize itself, organize its financial capital, and create a new business from scratch. So that's kind of the one channel, is to build something new, this kind of startup vein. The other is that we can also use the same strategy to save existing businesses, to transition them into community ownership. So if there's a retiring business owner, somebody who just wants to exit, but it's a store or a business or some kind that is really important to the community, then we can do the same thing, create a community entity that is funded and invested by the community to purchase that business, allow that existing business owner the opportunity to move on. So just a quick rundown, like how it happens. Like I said, individuals, members of the community can put money together into this community-owned entity. They own shares, they elect a board of directors, they sort of maintain community control and community ownership. That can be paired with outside investment, whether it's an angel investor or a bigger investor of some kind. It can be paired with conventional finance, like a loan from a bank, and then it can be used to either start up or purchase the business in question. That's just kind of an overview of how it kind of goes down. And I always like to say, if it can work as a business, it can work as a community-owned business. There's nothing sort of like magical about the kind of business it needs to be. It just needs to be a survivable business. The only difference is kind of like where the capital is coming from. And I guess I should put a footnote here too, like, and the governance structure is a little different too, because rather than being a sole proprietor or being a limited partnership with 2 or 3 people, you have a more distributed ownership that, again, like I said, elects a board of directors to hire the manager and oversee things at the governance level. They're not operating the business on a day-to-day basis, but they do provide that kind of overall governance. So the way that we do that is through investment crowdfunding. And I'll give you just sort of a quick history lesson if you're not familiar. Investment crowdfunding is a relatively new thing, and it's in response to the fact that there were all these laws that were passed back around the Great Depression to try to protect the average citizens from being taken advantage of by unscrupulous people who were, advertising, oh, invest in this thing across the country or make a bunch of money this way, and putting stuff in the paper. And they were just ripping people off with these sort of fraudulent investment type so-called opportunities. So they passed these laws to restrict very tightly how you could offer investment in your businesses. And they made this category of accredited investors, which is like super wealthy people who either have high net worth or they make a lot of money. They're allowed to participate in these kind of investments of different varieties. But unless you're friends or family with someone in a business, you can't just go invest in their business. The local coffee shop can't just put an ad in the paper that says, hey, I'm trying to expand, invest in my business and I can expand. That's illegal, and a lot of people don't know that, but there's sort of all these barriers that were originally pretty well intended, but they had the impact of, first of all, preventing people from investing in their community in a major way and making it so they could only invest in Wall Street because there were no local investment opportunities in their local and small businesses. And it also denied those local and small businesses a source of capital because they couldn't just make an appeal to their community. They had to go through these traditional institutional routes like banks and entities like that, or they needed to find wealthy investors who could write a big check. So there's this huge swath of the country that couldn't participate in investments and who businesses couldn't seek capital from. So when they were passing all the recovery stuff, laws and legislation in the aftermath of the housing crisis in 2008, 2009, one of the things that they put in there was this investment crowdfunding legislation to try to democratize access to capital and create more investment opportunities for folks. So you can see the pace here. It took from about 2011 to 2015 for that to actually get implemented and have the rules written and so forth. But the byproduct of that was investment crowdfunding. So what does that mean? Traditional crowdfunding, which we sometimes call gift or reward or donation crowdfunding, is what you might be more familiar with: Kickstarter, Indiegogo, GoFundMe. And that's like, hey, I'm recording an album, throw us some money, and when we're done, we'll send you the album. Or we're trying to make this thing, we're trying to make a movie, we'll put your name in the credits, or we'll throw you a party, or it's kind of like you give money just because you just want this thing to happen, and maybe you get something in return, maybe you don't. But prior to this legislation, you could not sell shares of your company through this channel, and you could not sell debt. You couldn't borrow money through this channel. There could be no financial returns. So no securities were able to be offered. So when this legislation got put into practice, it created investment crowdfunding. So that's different. You can sell ownership. You can say, I'm selling shares in my company for $500 each. It's this percentage of the ownership. These are what the economic rights are. These are what the governance rights are. You can sell debt. Hey, I'm borrowing this money. You can purchase it for $1,000. You'll make 3%. I pay back over 7 years bi-monthly. You can offer financial returns. So those are the fundamental differences, that you can actually offer securities. You can offer financial returns. You can sell part of your company. You can raise debt. Those are the fundamental differences. How those things are actualized, people might say, like, well, why wouldn't I just do Kickstarter? If I can just get money for free and not have to give anything up. Well, it turns out it really makes a big difference when you offer these things in return. Nationwide, the average successful gift crowdfunding campaign raised $7,000. The average successful investment crowdfunding campaign raised $250,000. So obviously just appealing to a sort of a market of people who are willing to participate on a very different scale. You can attract way more capital. You can just do a lot more. It's of course theoretically possible to raise more money through gift crowdfunding. You know, sometimes that's, you see these things about like, oh, this people are making this movie and they raised $1 million or whatever. And you might be like, oh, cool, I want to raise $1 million. I'll do that too. But odds are you're looking at a much smaller raise. So that's one of the benefits really there. So that's kind of the background of like Center for Community Ownership, and we use that mechanism of investment crowdfunding, and that segues us into this Crowdfund Main Street project. And just to be clear, the stuff we're about to talk about now, the Crowdfund Main Street project, everything prior to that was sort of like, I was talking more about like full community ownership of businesses, whether it's starting something new or transitioning it. Everything I'm talking about from this point forward is not necessarily about businesses going into community ownership. This is just about businesses and organizations that want to raise capital, okay? So Crowdfund Main Street is, we looked at these two categories, the gift and the investment crowdfunding groups. They are one of these. They are like these platforms. They are a platform that focuses on and hosts investment crowdfunding offerings. They are one that just happens to be really oriented towards local economies, local entrepreneurs, local businesses. It's a little more values driven than some of these other ones that are kind of more mass market. This is a shot of their homepage, and this is kind of what sort of the offerings look like. So just like you would have a Kickstarter, people have their own pages. It outlines the details of their business, what they're raising money for, has their disclosure documents, has their statements, and you can actually conduct the transaction through the platform too. You're like, oh great, this company is selling shares for $1,000. I want to buy 3 of those. You can conduct the transaction. The investors are managed, the communications happen through there. You can ask them questions through the platform. There's all sorts of, it's kind of like a one-stop shop for where the investment crowdfunding offering gets hosted. So Crowdfund Main Street is our partner, the Center for Community Ownership. For these projects we work on around the country, that's where we host the offerings that we're doing. So we have a close partnership and a close relationship with them. And I had this idea around the same time that they had a very similar idea, which was, what if we created a platform like Crowdfund Main Street just for Montana? Because Crowdfund Main Street is nationwide. So it's just sort of it's like any business anywhere can be on there, and it doesn't have that kind of concentrated effect. And they were thinking the same thing. Oh, it'd be really interesting to create kind of unique branded platforms for specific geographies. So we're working together to create Crowdfund Main Street Montana. So it's basically going to be a version of their portal that just hosts offerings that are based in Montana. And we think this is compelling because we feel like if we can get a good concentration of that, we can create a real community of people in the state of Montana who are interested in investing in businesses and organizations in Montana. So it can be kind of the go-to place for businesses and entrepreneurs to raise money from the community. So we think by creating that critical mass, by creating that focused kind of attention, we can really benefit people who are looking to raise capital. And basically, any entity can raise capital through this way. If it's a for-profit business, they can do it by selling shares of ownership, or they can do it by selling debt, like we talked about. And nonprofits can actually do that, can take advantage of this as well. They can there's no equity or ownership of a nonprofit, so they can't do that, but they can raise debt. And that's, if they've got a viable way to pay it back, if they're investing in a facility or developing a program or something that they have a way to pay that debt back, they can absolutely do that. So we're looking to work with them to create this platform. And one of the big ideas that we have is that there's kind of capital concentrated in certain parts of the state. And if people are in those parts of the state, sure, it's a lot easier to kind of find that access to it, make those relationships, whatever. But we want to make it so that money can actually be accessed and be distributed throughout the state. So you don't have to be in Bozeman to access Bozeman money. You don't have to be in Missoula to access Missoula money or Whitefish money. So that's kind of our big agenda. And these offerings can be structured also so that it's not just investors in Montana. That's going to be probably the main audience for most of these, but funds can be invested from all over the country. It's not a problem to attract that kind of capital as well. So there might be people who are just interested in general Montana. They might have some relationship with Montana and live elsewhere, but basically it'll help access that those funds. So this is Jenny Casson, who is our main legal partner. And I just want to put her up here because she's that legislation, that investment crowdfunding legislation that I referred to in the earlier slide, she actually is one of the people who helped write that legislation. She is our legal partner that provides all the kind of legal, financial, securities, compliance expertise. And she's really a national leader in this field and really just an excellent person to have in our corner. And her group and Crowdfund Main Street are very closely connected. They're very kind of well integrated. And Jenny and Crowdfund Main Street are both major partners that we work with a lot and major partners in this Crowdfund Main Street Montana project. So I just kind of wanted to kind of put that up there and just say, like, I don't mean this to be too kind of like salesy or something, but there really is a great opportunity here, which is they are some of the best, if not the best, at what they do nationwide. And to just pay for the package of services that they offer on normal, if you just approach them, we're like, hey, I'm a business, I want to raise money. It's like $32,000, $33,000 up front just to kind of work with them. But they're really interested in making this happen and making this go. And so for at least this first cohort, I don't know what the rates are going to look like moving forward, but the only upfront cost to them, if it's a business that looks like it's going to make sense and they want to post it, is $5,000. So it's a really, really steep discount for this package of like all the support you would need to do all the legal and financial and securities work effectively. And so it's a really great situation that they are offering because they really want to see this succeed. And just a couple other quick notes on the like kind of the fee structure as well. Like any platform, like Kickstarter, any of these platforms, part of how they stay afloat and cover their costs and expenses is that they take a percentage of the raise as well. So Crowdfund Main Street takes 6% of the total of the raise. And then for us all working together as well, depending on the complexity of the project, there can also be a fee on the back end, which can vary depending on your specific situation between $5,000 and $15,000. But that's not money you have to pay out of pocket. That's money basically you can raise from the community. So there's that upfront fee that, like I said, the $5,000 for this particular first cohort in the pilot project. And then there's the platform fee, and then there's a little bit of that back end fee that we would figure out if it was something that people were interested in moving forward on. But again, you don't have to pay that out of pocket. That comes right out of the raise. You just have to set the raise amount appropriately. So those are the main points that I want to kind of like put out on the table. And then I'll just open the floor up to questions and go from there.
So quickly before, I'll open it up right after this, but I wanted to make sure, Andrew, because when we spoke before, you had said you're looking for you need a minimum of 3 businesses to participate in this cohort.
Right.
Right.
Yeah, we're looking at, I need to ask what I started to think about this, like, we haven't had the problem of, oh, is there a maximum number for this first cohort? That hasn't been the problem so far, so I don't know if it will be an issue, but I need to reach out to them. What we've talked about previously is 3 to 5. So I don't know if they have any reason to feel like, oh, we don't really want to go more than 5 for this first launch, or if they're like, no, bring everybody, bring them all, you know. So yes, the current thing is 3 to 5. We're in discussion with about a half a dozen different ones at varying levels of like interest and commitment. And they're basically about 2.5 that are like, let's do this, and still waiting to hear some other things from other folks. So
thanks for clarifying that.
Yes, thank you for that question. Yeah.
Any questions?
I could start with one, if you guys don't mind. So I
Please.
guess one obvious question, Andrew, for you and potential viewers that may be curious, I guess what's the primary difference between the Center for Community Ownership, that kind of basic model, and the standard cooperative model?
Yeah, so that's a great question, and I always feel like I have to be, or I always want to be a little delicate around this, especially when there's not someone here to kind of represent the co-op perspective. But I will make the case for this model and just encourage anybody who's thinking about it to kind of like do their research. And one thing I will say also is that there are certain states where there's a really significant practical difference because the co-op laws vary from state to state. And in some of those states, it's like co-ops are really rigid, like one owner, one share, one vote, and they're like not allowed to bring in other investment capital. There's like a lot of restrictions about what they can do. Montana actually has some of the loosest co-op laws, so those distinctions are a little less dramatic in Montana than they are elsewhere. But the things that I always make the case for is that one, for better or for worse, our approach is a little more flexible. You can design it in different ways with the governance. It's a little less constrained. You don't have a set of laws. It's not governed by statute how the governance of the business is up there. So you can really do interesting things about different classes of share, have different voting rights, and within that, you can restrict the voting rights to different geographies, and you can have investors. You can just, it's really flexible because you're using sort of conventional corporate structures, which have a lot of flexibility in terms of how they're designed. Some of the capital considerations, it's a little more flexible in terms of capital raising. I think that this is a little better strategy if you're looking to actually build wealth in the communities, because you can create these kind of actual financial assets that are holdable and sellable and things like that. And the other thing that sometimes comes up is that there are business service professionals like attorneys and accountants and things like that, that like anyone who knows business law can support a business like this because there's nothing legally different happening. But co-op law kind of sometimes can require attorneys or accountants with special expertise. So sometimes access to those business support professionals can be a little harder to come by or just a little less available. Those are kind of the main points that I usually make. But I also want to reiterate, for those community ownership projects, it's definitely in the same spirit of co-ops. We're trying to sort of achieve the same thing with just a little bit of a different tactic.
I could follow up with a different question, Carl, if that's okay.
Sure, maybe we'll put a finer point on that. So I think your question, Jason, was about the Center for Community Ownership and the difference between co-ops, but the crowdfunding Main Street really is an opportunity for businesses to raise capital. And it's a raise capital in a different way than what was really available through banks or other investment opportunities, right? Using potentially local investors. So that's kind of two separate things.
Yes.
Okay.
Everything I just said was specific to the first things I was talking about, which is full community ownership, the community ownership project, which is distinct from just the crowdfund Main Street is just like anyone who wants to raise capital, not whether they're looking to transition into community ownership or not. It could just be a business like, hey, I need to buy a van. I need to buy some vans or expand my business, or it's like anyone who needs to raise capital. It could have nothing to do with community ownership in general. So yeah, thank you, Carl, for clarifying.
Yeah, thanks, Jason. What's your follow-up?
So maybe this is two different questions, but I might as well throw at it. Is there a minimum raise that's ideal? Is there a maximum raise? I know that with crowdfunding, I've never actually worked on a successful crowdfunding campaign, in large part because the ask is often too high. So I'm curious what the min and max is.
Yeah.
And then also, if I am a potential investor, and I am potentially looking to take my money out of my money market or my mutual fund or my stock investments, why would I do that? What's the investment? I mean, is there a difference between my return? What's the pros and cons here? And then what can I expect my return to be? So maybe that's three questions.
Yeah, okay. I'll work through them and see if I can get it all covered. So yeah, first question. So a little bit about the sort of the mechanisms of it. Like with Kickstarter, you do need to set a minimum amount that you have to at least reach that goal to collect. And if you don't reach that goal, you don't collect. And so that is part of the sort of strategic support that Jenny Casson Consulting, the attorney I was talking about, and Crowdfund Main Street works with clients on, which is, okay, what's the minimum amount that you're going to walk away with and feel like this was worth it? And what's the minimum amount that you can actually do something with? You know what I mean? If it's like, it doesn't really help if you raise some amount of money that you're still kind of stranded and it doesn't like get you anywhere. So that's definitely a part of the process, is helping people figure out, and strategically, like what's realistic in your community, to raise and the kind of appeal you're going to make. So that's part of the process that is very situational and situation dependent. And then you can also set a maximum, which is like, so you hit your minimum. As soon as you hit your minimum, you collect everything up to and then beyond that. If you make it a little bit past your minimum, you collect the whole amount that you raised. You can also put a cap on it, which is like, we don't want to raise more than this amount because it's just too much. We can't use it effectively, like things like that. So you set those two thresholds, and as long as you sort of fall in between them, you collect. As far as what is actually wise, like I said, or the right amount, totally situational, and that's part of the consulting and support that you would get. And for this Crowdfund Main Street project specifically, we are looking for people who want to raise at least $100,000. So that limit may change as things get up and established, now things move forward. But for the time being, that's the scale that we're looking at, is like roughly, if it's like a little below 100,000, I'm sure we would talk about it, but basically sort of like 100,000 and up is what we're looking at for right now. Does that answer all of that part of the question?
Yeah, that part of the question, because, you know, there'll be the question about, well, I have a $20,000 project that I need gap on, and I could go the debt route, but my debt to worth is going to be all wackadoodle, and I won't be able to get that. So can I use crowdfunding, you know, for gap purposes?
Yeah.
But for you're saying for this round, maybe that's not for this round, maybe that's for the next round.
Yeah, and like I don't know if it shifts. I don't know how low it would shift. Like it's hard for me to know exactly, but at least for the time being, that's what we're looking at. And actually, that reminds me, the example you just brought up. There's a project we're in discussion with that is actually doing something I think pretty similar to what you're discussing. They are planning to use this to raise equity capital for about 20% of the project that they're going to do. And then they're going to take that to the bank and say, we've got our 20% equity, and then they're going to borrow the remaining 80% from the bank. Because right now they don't have enough to go to the bank and get that conventional loan, but they're going to use this equity in that purpose. So that is a strategy that kind of could work as well. I think this was the second or third part of your question was about why would an investor do it? And so I'll start by saying, when you are designing an offering, you have an incredible amount of flexibility. And again, this is part of the consulting that Jenny and her team sort of put people through. There's a lot of different ways to structure equity in terms of whether you're offering dividends, offering governance rights, if you're offering different financial rights. There's a lot you can do, and she can really walk people through what's going to work best. So if it's an equity offering, they might be interested because they want to see this kind of business happen. There might be just sort of like an emotional motivation. They might see it as practically a wise investment because they believe in the success of the business, and they believe that they will either receive dividends or the business, you know, they will eventually sort of collect on having that ownership percentage. When they're issuing debt, similarly, it's simpler because there aren't as many options, but they still can set their terms. If they're currently looking at a business loan that's going to cost them like 6 or 7%, they might be like, I'd rather crowdfund this money at 4.5%. And then they can turn around and they're basically offering the community 4.5%. So if you're sitting there with $10,000 in a savings account that's making 0.5%, then all of a sudden 4.5% is really attractive, you know? So depending on where that's set, I mean, even if they're offering 3% or 2%, you know, it might be that you have idle capital that is not even earning that, you know, or is earning less than that. So there's always like some mix, I think, between, you know, we're looking for business and organizations that have like a good relationship or really offer a positive benefit to the community. So part of the appeal is going to be the practical kind of like, oh, this is a chance to actually make a meaningful investment and get a return. And part of it's going to be that motivation for supporting the local economy, supporting the business, supporting the entity in play. So does that speak to that? Did I miss anything in there?
No, I think no, that answers it. I mean, because, you know, if I try to put myself in the shoes of saying, well, I'm going to pull my money out of stock market where I'm earning 8 to 12% to do a community-based type investment,
yeah,
or a crowdfund in some business or some entrepreneur I believe in, the question is, why would I pull it out where my returns and my yields are higher when, you know, why would I do that? So yeah, you did. But I do have another, since you mentioned the equity to be leveraged for debt, who are the guarantors on those loans if a lender is requiring guarantors?
Yeah, that would probably be a question for the attorneys. I don't know if it is just the business itself and the officers of the business, or if it, you know, turns around. If it is, that's a great question. I'm not actually sure how the mechanism of that works, but I know that it has been conveyed to me that it's not a problem. so I don't think it's an obstacle, whatever the proper channel is on that. My guess is that it's the officers of the company.
Yeah, because not every deal has a personal guarantee requirement, but there may be a personal guarantee requirement if, for example, a federal tool is being utilized as well.
Right. Well,
Brian,
go ahead, Carl.
I was just going to jump in there and make sure, Brian, if you had any questions, that you've got a chance to ask them. You're still on mute, by the way, if you're trying to talk.
Yeah, you bet. Jason's answered a few of the questions I've had so far, and just listening up now, and it's answering my questions. Thank you.
Okay. Yeah. Feel free to jump on in and butt in.
Great. Thanks.
Any more, Jason or Rich?
I had a quick question. Jason did ask a couple of questions I had written down here, but and I suppose every deal is different. But are there usual minimum threshold for investment for investors? Like, are they going to be able to come in and say, I've got $500 to put into this, or is it going to be like, no, these are $10,000 share?
I think it really is very situational, and so partly depends on people's evaluation of the market of their potential investors, which again is something that Jenny and company would help with. And also some of the goals. You know, there's some people who accessibility is a real goal. You know, they really want to get as many. They're using this not only as a strategy to raise capital, but also to build relationships. So they want to include as many people as possible. So they might, you know, push their share price down to like $100 or $50 or something, because they really want to make it as available as possible. And then maybe there's other people who evaluate the psychological aspect of that. It's like, well, if I make my share price $100, are there people who would pay $500, but they're only going to pay 100 because that's one share, and instead of buying one share at 500, they're buying one share at 100? Or we only want to we'd rather deal with a smaller pool of investors, so we're going to raise our price to 1,000 because we just want, you know, people at that level. You know, so I think there are a lot of considerations that go into it, but I don't think there's a one size fits all. I think it is pretty situational. But I kind of imagine that in Montana, and if we're looking at sort of rural areas and the scale of some of these things, you know, there are some investment offerings on some of these platforms where the minimum share is like $10,000 or $25,000, and that seems like that probably is quite a bit too high. I'm guessing just intuitively that we would be looking at like 500 to 1,000, and maybe even some that go below 250, maybe, you know, things like that. But I think it is really situational.
I might hold that other question for Rich. I might turn the question back around for Jason, you, and Rich, you, and sort of ask, you know, from your experience, what do you see? Because I've been talking to Andrew about this, and we've been talking about alternative funding mechanisms now for going on a year in other circles as well, and sort of trying to educate the investors. So all of us, or all the people of Montana that might have some interest, whether it's investing $25 or investing 25,000. Where, you know, what we might run into. We're just not sure yet. Do you have any insider thoughts on that?
And similarly, Brian, I don't know if you have talked to investors, but if you have kind of a sense of scale as well from your perspective of any conversations you've had, I would love to hear that as well.
Absolutely.
Yeah, and I'm just now getting to the point with my company to where I am just dipping into this world, and it's brand new to me. This is my first company. So I haven't had many conversations with investors to this point.
Do you have, when you imagine that, like, do you like, and you think about your kind of target investor, do you have a sense of what kind of asks you expect to be making, or who you expect to be reaching out to or talking to?
I'd expect to an ag tech investor in the ag tech space. Are you asking as far as an amount of an ask?
Yeah, or just kind of what you, yeah, just anything you have to say on that front. Yeah, just sort of like audiences, amounts, things like that.
Like for me, an ask would be around 600,000.
Okay.
I think that, I mean, it fits in the model, right? I mean, if you're looking at a minimum of 100,000 in a raise for this first cohort,
yeah,
it would fit in
oh,
that.
and yeah, I guess I should have said as well, there is an upper limit set in the law that companies right now through this channel can raise from unaccredited investors. So basically this is kind of like through the portals and general population, 1,070,000. They are possibly on the brink of raising that threshold to 5 million. That's an SEC rule change that's kind of like under consideration. So by the time someone sees it, that could happen like any day now. And it is possible to pair that 1,070,000 with accredited investment as well. So you can get above, you know, your target amount from like bringing in other investors, but to like do an offering through the portal, that is an upper threshold. So yeah, so the 600,000 would follow squarely in there. But,
okay.
yeah, Rich, Jason, do you have any responses to Carl's question?
Tell me the question again.
Well, I was kind of looking from the investor side. You know, you asked it one way, Jason, is like, what's going to motivate me? So from your experience working across Montana, and we've had some conversations as well, and your meow call around, hey, it's going to be really important that we get some capital available to businesses in Montana. And one of those ways could be from Montanans. So this could be a platform for that. But when you're seeing that, what do you think sort of the appetite might be for Montanans to say, yeah, I want to invest? If we're looking at $100, $200, $25,000, I mean, is the whole range available? You're on.
Yeah, I unmuted and then muted myself as I started to talk. I mean, I think one of the challenges, Carl, that you and I have talked about, and I think we touched on this one night in Shelby. That night we were on the sidewalk and it was cold and we were like, yeah, let's talk about this more another time. The problem I think that we're going to have is that the people who have capital, who may want to, are motivated to invest at the higher limits. So higher limits, let's just say people who, unlike me, who have more than $5,000 to potentially contribute to something like this, they're there. They just need to be brought out of the woodwork. So my curiosity would be, and I don't know the answer to this question, so I'm thinking out loud more than anything. Is it going to require that lower threshold first? So that law of diffusion of innovation, we get the early adopters at the lower dollar amount. And then once this model is proven, those more community-minded potential investors who have higher net worth, but maybe they're not accredited investors, but are willing, I think the most likely early adopters are going to be people like maybe me and Rich, who have, well, I can't speak for Rich, who may have some motivation and desire to do equity investments or participate in a debt raise like this, that we would be taking money away from some other investment to do it. So that's a smaller amount. That's my gut, is to say, I think the early adopters for this are going to be the lower dollar amount investors. And then once the model's proven, these people are going to say, oh, the higher net worth folks, they're going to come out of the woodwork. And then we're going to have more. But I think the model needs to be proven first.
Yeah.
Yeah, I think Jason's spot on. You know, I live in a small community, and I could see, you know, a campaign type thing where you're getting some smaller dollar investors to do an initial run, you know, the $100 to the $500. But there is quiet, big money in some of these small communities who, I think if they'd see this concept proven, then you could see some larger dollar amounts. But I think initially it would be, you know, some of the smaller, but, you know, so a lot of these smaller communities are really community minded, and they could get together and fund a project like this, $100 or $500 at a time.
Yeah, well, you see that happening where some of these projects that are, you know, even for $250,000, they get there without any big investors. You know, it's all small, pretty modest sized.
There's no rules that even if the share price is $100, you could still buy.
You can buy 1,000 of them. Yeah, there's no limits in that way.
Yeah, and I think the other thing too is that more folks, especially in the smaller communities with you know with credit unions and, you know, electrical co-ops and things like that, the knowledge of the co-op model, and generally speaking, the lower price of entry, that familiarity is going to translate, and I think that's most likely how it's going to be proven. We could be totally wrong, and the folks in the areas who, you know, who've got capital, maybe they're willing to come in. I think they're going to be the anomaly, though.
Well, and my hope too is, like I said, you know, talking about with that one slide, my hope is that even if there aren't a lot of big money, you know, potential investors in a small community, my hope is that we've still got the centralized place that everybody in the state is paying attention to. So even the folks who might have bigger money elsewhere, like, oh, that's great. I would love to capitalize this project in the small, it looks like a totally solid idea. I want to make this happen in this small town, even though I don't live there. I just think it's great. I care about Montana. I care about rural communities and rural economies. So I'm going to participate, and it benefits me too. You know. I'm also thinking, jumping back to what we were talking about earlier, you know, there's this piece of research that was done, this question of why would someone participate? And so the one thing, Jenny often walks through this thing about like what kind of returns are people actually getting from the stock market, and sometimes they think of those returns as being higher than they really are. And there's also the other question is kind of the volatility question, where people are seeking opportunities that may feel a little bit more stable than the stock market, and some of these local investment opportunities may. And you know, the first full month of the pandemic, investment crowdfunding participation actually went up. People were kind of worried about like, are people going to just be on like lockdown with their money? But it seems like the prevailing effect was people moving their money from the stock market, where they thought it was less dependable, into more of these kind of connected investments.
If I were to have made a guess, and I think we probably did, Rich, correct me if I'm wrong, we made the assumption early on that people were going to be seeking debt and seeking bailouts during the initial, you know, the kind of shock of the pandemic. I had a sense that crowdfunding was going to be something that folks are going to have to look for.
Yeah.
And in particular, like a lot of people supporting, and we talked about it as, you know, selling gift cards.
Yeah, pre-selling stuff. Yeah.
Which isn't a whole lot different than what we're
it's similar. It's similar. It's related for sure. Carl, should we talk about some of these questions that came through over the email?
Yeah, I think we touched on a couple of them. You want to grab one that's on the top of your?
Yeah, well, I just wanted, one of the questions is about, is there an average dollar raised for Montana? I don't know if that statistic is out there. Like I said, I've got that one that the average successful raise nationwide is $250,000 for investment crowdfunding. I don't know what the state, if there's a state figure for that. One was, how would this work if the person or the business doesn't have like a huge network? And that's a very like astute question, because a big part of this, you don't just like put it up and it happens. Like there's definitely a lot of like leg work and stuff that needs to happen on the ground, as far as people getting out in their communities, encouraging people, getting publicity, getting press and things like that. So that's obviously going to be easier with a larger sort of professional or social network, but it's not impossible. You know, that's part of what our support would be to people who are participating, is figuring out how they can make the most of what they do have, figuring out how to get the most attention, how to get the word out. We are hoping that this all happening together is going to generate kind of a critical mass of attention and earned media and things like that. So hopefully that people will be drawn to it just because it is this collective thing. It's not just one business out on its own trying to do this. But that's something that we would work with, is like, what's the right strategy given the network that you do have? Like how can we make the most of it to be successful? There was a question about the turnaround time for,
Andrew, can I
Oh, yeah,
just
yeah.
answer that question? What's your methodology? But to accomplish, if Center for Community Ownership and Crowdfund Main Street are going to provide some technical assistance there, what's the methodology to raise awareness beyond just saying, writing a press release and sending it out to the TV stations?
Yeah, so that is more Crowdfund Main Street's area of expertise than mine particularly. They've run a lot of people kind of like through these campaigns, so they have a lot to say about social media approaches, getting earned media in like a meaningful way, having investor meetings, how to like strategize who you're actually going to try to sit down and meet with one-on-one. Like that's their area of expertise. I support that, but I'm not sort of like the driver there. So I don't know what their answer to that question would be, but they have a lot to say about it. I can tell.
No, yeah, I'm sure they do. I just wonder, when we have our rural partners meeting with Amory, which is how we met Carl and Carly and stuff. There's local, state, federal, and private sector economic development partners that we're all going to have a stake in this, and we're all going to pull for it.
Yeah.
So I would imagine those companies that are engaged with small business development centers or whatever their SBA partner is, or whomever, everybody's got their own network. And so
yes, that's a great point. And yeah, we would definitely intend to leverage all of those kind of people with a common interest and people who they're already connected with, for sure. So yeah, that's a great point, that even an entity that doesn't have a huge following, if it's got those kind of support elements in its corner, that would go a long way. So yeah, that's a great point. One of the other questions was, payment turnaround time. I don't have a specific number on that, but it's kind of like once the campaign closes, how long does it take for you to get your funds? It's not burdensome. I don't know exactly how to articulate it, but there was kind of the question was phrased in the context of like, sometimes grants are awarded and then it takes like a really long time for the check to actually get cut or sent or whatnot. So I don't think it's not like that. It's a much more rapid process. And then another question was about like the requirement for business planning. And sort of saying like, kind of like, what's the threshold for business planning? And that's a great question. I'll start by kind of contrasting. Okay, well, I'll say this. We're definitely going to like vet the people who are the businesses and organizations that are interested in going up on the platform, because we don't want to set anyone up for failure. So we want a certain degree of maturity of, I'll say it this way, either sort of like an established business that has a track record that it can point to and has, isn't in crisis and has a certain amount of stability and isn't just looking for money to prevent itself from failing. This isn't just like a crisis kind of thing. It's more of like building a constructive future. So like a stable business that has a track record. If it is something that's more in the startup side, we would need to see like a little bit more like, this is someone who has experience in the field. They have a related track record, even if it isn't this particular entity. We would want to be pretty convinced that we were setting everybody up for success, the business, the investors, everybody, because we don't want to create a tough situation. So we have a sort of like a vetting where we need to sort of like have those conversations and figure that out. But it's not like you're going to the bank and we run you through the algorithm and this is how you prove whether you're worth it or not. It's basically like, we want to get a feel for where things are at to make a decision about whether we feel like it's a good match to go this route. But once we kind of do that and put up on the platform, you don't have to prove anything to us or to the bank or to anybody. It's basically just to your community, to your potential investors. You need to make the case that you're worth investing in, that you're going to use the funds intelligently. And that's part of the stuff that's posted on the site. It's like, this is what we're using the funds for. This is sort of like our projected revenue. These are all of our relevant disclosures. Like, that's who you're making the case to. And unlike the bank, it's like, you don't need a certain credit score, you don't need collateral, you don't have to, you know what I mean? It's basically like, you just need to, like I said, make the case to the community that you are, that you're worth their money and that you're worth it. So that was,
Should have a follow on to that. Go ahead, Rich.
I had a quick question, then I have to jump off. I have a 1 o'clock appointment, but kind of along those lines too, you don't require those necessarily all that initial stuff, but what about yearly ongoing governance and reporting for those companies? Do they're required to assume report in order to possibly pay dividends or share price, that type of stuff? Is that a yearly?
Yeah, that's something, again, that our attorneys can advise on. And it's the most significant thing. So with equity investors, they are sort of entitled to access to a certain kind of information that basically you can post and make available. And that's a pretty simple thing. And then there are dependent equity and debt, and whether paying dividends or not, or whether there are certain forms that you need to send on an annual basis for tax purposes. So just like you get I think it's a 1098 INT from the bank that says you earned $5 in interest income from your savings account or whatever, you would have to send that to your debt investors, for example. And that's a pretty straightforward thing that we can help you get set up with. It's basically you'll have a spreadsheet of all your investors, what you're paying out to them. So you just need to deliver that to your business accountant and say we need to issue these forms. So, we can put you on the right track and get you set up for that. But yeah, it's fairly minimal as far as what actually needs to happen in terms of reporting and things like that.
Great, thanks. I have to sign off. It's a really interesting presentation. Thanks.
Of course. Thanks for being here, Rich. Appreciate it.
Yeah, thanks, Rich. Good afternoon.
And that does, I do want to just reiterate, because sometimes this can get lost in the shuffle, is that you really can design this in the best way possible for you. And you always need to balance kind of what you're offering to be attractive to investors and what's going to work for you. But you really can say all right, I'm looking at, I'm raising $1 million in debt, and I want to borrow over 10 years and pay 1% interest. You know what I mean? We might have to have a conversation about how attractive that is, but if you're a super well-supported nonprofit, maybe that's great. You know what I mean? Maybe people would be more than happy to do that. And you can build into your offer, whether you pay monthly, maybe you pay annually. That's also an option. You know what I mean? You can set those terms. You have a lot of control over it. And so it's a lot of strategy to figure out what's going to work. But people often say, well, what do I have to offer? What do I have to do? Whatever. And it's well, you can do basically not whatever you want, because there are some limits, but almost whatever you want. And just try to figure out whether that's going to help you achieve your goals or not.
Brian, any last questions, thoughts, concerns?
He answered a bunch of them. You talked about a stable business you're looking for. Would you be looking, and it's probably situational, are you looking for sales or some traction or some contracts in place, or?
Again, very situational. And it could be a startup where it's we don't have any track record, but here's who's involved, here's why they know what they're doing, here's what our business plan and projections say. If you can make a strong case for being successful, that works too. Whether you are brand new, been around for a little bit, sort of partially new, well established, we can be flexible enough to evaluate all those different situations.
Okay, sounds great.
Yeah. So yeah, if you're in, I'm going to put my email address in the chat.
Yeah, and I'll just say, Brian, I have your email now from the registration, and I'll be sending the recording so we'll include Andrew's contact information in there as well, if you want to follow up.
Absolutely.
Just in the last 2 minutes, with anybody on the call, Jason, you're thinking about, if there's what would be next? What are some of these questions out there, or even Andrew, for you, if we're going to do another one of these in next week after that, so on and so forth. Anything's outstanding in this financing side that we might dive into and try to find somebody to have on the conversation?
I wasn't prepared for that question.
Well, even to Jason or Brian, I mean, Brian, one of the things, if you're sort of in the stage of brand new for you, is there anything in that other things that maybe you've been thinking about we haven't talked about today? I don't want to put you on the spot. I know if things are brand new.
Yeah, and yeah, for me, things are pretty new, but it sounds like to me everything's just pretty situational, and opportunity versus whatever, and whatever the investors are attracted to an offer, and is what it sounds like to me. And I think it's definitely something to look into and have some conversations to where maybe I'm a little early at the stage I'm at now. This might be better suited for a little later down the road.
Well, I wouldn't assume that, Brian. If you want to talk more about it, let's talk and see where things are at, because it might be a good fit. And if not, we can figure out when it might be a good fit and sort of sort that out. So yeah, definitely reach out.
Brian,
if I may ask, Brian, where are you located?
I'm in Laurel.
Okay, great.
Yep.
Yeah, Brian, I just concur with Andrew. Of course, the little I know about your business, but the stronger you document your assumptions, the better you button up your argument, your point of view, the market data that you've put together, your policies, procedures, protocols, whatever those things are that show that you are Loctite, ready to roll. The Eisenhower quote always comes to mind with me. I think Eisenhower said something to the, I'm going to butcher this, I always do. In preparing for battle, plans are useless, but planning is indispensable. So having like a fully thought out, contemplated, and supported set of assumptions, that's going to prepare you for a pitch deck, for a business plan, for a strategic plan, for a marketing strategy.
Capital raise.
Yeah,
Right.
for any of it. Yeah, and if you're going to go the debt route, it's the same set of stuff. It's just the cover page is a little bit different.
Yeah. And I'll say, Brian, I mean, we sort of started out this process of thinking like we were really going to be leaning towards like established businesses raising capital. And of our three main, like most likely prospects at this point, two of them are brand new with almost no established history, but they have such a compelling case to be made for what they're doing, and the fact that they're going to be good at it, that we're like, great, we feel comfortable moving forward with them. So yeah, don't let that be a barrier. If you think it's something you might be interested, I'd love to talk to you about it.
Great, thank you.
Yeah.
And Jason, thank you for the advice. I appreciate that.
Yeah, and if you're in Laurel, I should know this, having grown up in Great Falls. That's Billings area, right?
Yep. Yes, Yellowstone County. Yep.
Yeah, if you need to connect with some advisors down there, the folks at Big Sky EDA are absolutely fantastic, and some folks who've been through this process before. So the equity raise and the debt raise early stage companies. Lorene and Kevin at Big Sky EDA would be people I would point you to.
Great, thank you.
Yeah, if you want an introduction there, we'd be happy to do it.
And
Awesome.
Dean is leaving, so otherwise I'd give you Dean's name too. But yeah, I'll tell you, Andrew, as soon as Rich jumped off the phone, he texted me and he said, hey, we should invite Andrew to join in our monthly rural partners call. We call it Montana Economic Opportunity Work Group. The acronym is MEOW. Carl joins us. If you're interested in participating in one of those, we've got one coming up actually Thursday at 2 o'clock. Love to have you on as a resource partner, and just to kind of get the additional word out, because we get some different folks on that call as well.
That'd be great. I'd love to. That's like tomorrow at 2 o'clock.
What's today? Wednesday? Yeah.
Okay. Yeah.
Carl, do you have the invite? Can you forward it to him?
Yeah, I mean, I do.
Great. I would love to be there. Yeah. Thank you.
Yeah, it's just casual, Andrew, and really it was a goal of ours to just try to do community building within the entrepreneurial ecosystem space. And one of the conversations that Carl and I have had with Barnett and Rich and others is, how do we steer people away from the idea, and I think it's misplaced often, that the only way to raise capital is through debt, and especially
or the only way is to like find rich people who can write you big checks. I mean,
yeah, totally. And we did a webinar on this equity, kind of crowdfunding thing with folks at the state auditor's office a couple years ago. But,
Yeah.
you know, my point is really, we have to get people thinking about how to equalize their debt to worth.
Mhm.
And raising equity in a business has got to be something people think more about.
Yeah.
Cash position, debt to worth ratios,
Yeah.
all those things are especially now critically important.
Yeah, and I mean, the nice thing about this too is it's like you can do it in a pretty painless way. Like I said, you can design the governance rights so that you can raise equity without giving up any control at all. And so it's really a pretty painless way to do it, frankly. I mean, it takes a lot of effort, but it's like, you know, it's not the kind of like raising money from VCs where you hear the horror stories about people coming in and like demanding changes or taking over or whatever. You know, it's not that arena at all. Like you retain all of the control and the ability to set the terms how you want it. So
Yeah, and especially companies, you hear horror stories of private equity firms and VCs and
Yeah.
angels even that come in and make those decisions and tell you got to do this, that, and the other, to the extent that they bleed the business dry. The news industry is fraught with this
Yeah.
problem right
Yeah.
now. And I'm a former journalist, so there you go.
oh yeah.
That this area, this topic is something that we have kicked around for a couple of years now as a problem that has to be addressed.
Mhm. It's crucial. And there's all this potential. I think the investment crowdfunding brings so much potential to the table. We just haven't quite got the traction yet. So hopefully things like this will help make it more common, get it in people's consciousness, allow people to figure out that it is a way that they can go about it.
Absolutely. Well, thank you, Andrew, Jason, and Brian, for staying on. This was a good conversation. We're 6 minutes past. So I'm going to sign off if you all have to jump off. If any of you come up with or think about as you're leaving, like Rich just did, like, hey, I want to answer this question, or here's something that comes up, send me a quick message and we'll see if we can put it on the next show or two and keep investigating these challenges that we're running into. So appreciate it, Andrew. Thank you very much for sharing today. And all of you, I hope there's a time that I get to share a beer or a glass of wine or something with all of you in person in the not too distant future.
One of these days.
Yeah. Take good care.
Sounds good.
Thanks, everybody.
Stay safe.